Hey folks, it's Doc's Market Minute for Friday, February 26th. I'm looking at the S&P here, and we gapped up this morning on the GDP report. Actually, the market had gapped up before the GDP report, and actually it's been going kind of sideways ever since. Now, there's a couple of reasons for this. I think from a fundamental perspective, the GDP was a little higher and a little hotter than was expected. So because of this, the rate hike might still be on the table come next month. So that's one of the big Fed meetings that we have 4 times a year where the chairman conference comes out. And those are generally the times when any kind of interest rate policy is going to be changed, or for that matter, any other financial policy. So we have thrown a little indecision into the markets based on the GDP reading. Now, there's a couple of other things too, just from a technical perspective here that we're seeing on the different fractal charts. As I look at the daily chart, we are approaching exhaustion down here. Anything below 38.2 generally shows that we've had a very linear trend and are about to slow down. Now, there's nothing in the law that says that it has to slow down, but typically the further down into this zone that it goes below 38.2, the more likely that we are to see a pause. Now, a pause can come in many forms. It can go sideways. It can actually go in the opposite direction or somewhere in between. So typically this is where I see prices go for a short period of time when we get into exhaustion here, especially as we go below 30 and really if we get down to 25 on this. So what's going to happen is all these candles are about to fall off the back end of this over the next few days. And so I believe we are going to see a plunge down here into exhaustion on the daily chart. And we're just seeing the anticipation of that as it comes into overhead obstacles. We're also seeing the same thing happening here on the 78-minute chart with extreme exhaustion, although this can clear itself in just a couple of hours by chopping around, and this is exactly what we're seeing today. So I do believe when all is said and done, obviously we're trying to peak above the 1950 level on the S&P, but we're going to end up printing some type of rising wedge going forward into the late winter, early spring. And so we'll have to keep an eye on it. The closer that it gets to the 2000 level, the more likely that we're going to see a break from this wedge to the downside. That's it for today's Market Minute. Have yourself a great weekend, and we'll see you back here on Monday.